Hi, and welcome back. This is an example of price breakouts that were automatically detected using the algorithm I'm going to show you in this video. The idea of price breakout is very simple and still very efficient if traded correctly. However, looking for a valid breakout signal is not just waiting until a candle closes above a recent high, simply because the price can still revert back to its previous range. For example, here we have a green candle closing above the recent highs, and still the price reverted back below the key level after faking this breakout situation. What we're looking for is actually a pattern that has better statistical odds. A stronger breakout pattern is often preceded by a liquidity sweep. So rather than simply looking for the breakout itself, we would first check whether the most recent low before the breakout is actually lower than the lowest point before the latest high. This gives the breakout a better chance of continuing in the same direction. So in other words, the most recent low needs to be the lowest within the recent time slice or time window before the breakout happens. Obviously, in symmetrical conditions, we have a high above the previous high, then a breakout in the down direction. In this case, it's a shorting signal. All of this can be automated in Python, so we can run the bot to detect these patterns occurring on multiple assets to increase our trading chances. But that's not all. In order to filter stronger breakouts, we will also use a moving average to detect the trend. Numerically, if a set of multiple recent candles where the breakout is happening are all above the moving average curve, then we have an uptrend. And we only consider bullish breakouts. In the opposite direction, if the candles are below the moving average curve, we will only consider bearish breakouts. The Python code I'll be using is available for download from the link in the description of the video, along with the data file I'm using here as well. So you can download these files and start running your own experiments and repeat the backtest I'm about to show you in a few minutes. So this is our Jupyter notebook file. We will start by importing the data, Euro US dollar 2003 up to 2023. That's 20 years of data on the hourly time frame. Then we're filtering the volumes where these are equal to 0. I'm adding the RSI, the EMA, exponential moving average, and the ATR in case they are needed later on. And this is our data frame. We have the open, high, low, close, the volume, the RSI, the EMA, and the ATR. In this cell, we're going to compute the moving average signal. So whether we have a set of candles, 15 candles here. If all of these 15 consecutive candles are above the EMA curve, we're going to consider we have an uptrend. If all of them are below the EMA curve, we have a bearish trend. Of course, you can experiment with a different number of back candles. Instead of 15, you can take 10, 15, 20, 25, depending on how selective you want to be with the detection of the trend using the EMA curve. Then we're going to detect pivot points, because these pivot points that are marked in purple here, these are the extremum points that we're going to use to detect the pattern if we have a liquidity sweep and then a breakout and so on. So these are needed for the computation later on. And these are detected using this function, mark pivots, which takes a data frame, a window, and a column of high and low, the name of these columns. And the reason it needs a window is that to detect a pivot point, we're going to compare the candle's high to the highs of the neighbors on the left and the highs of the neighbors on the right. If the maximum is higher or the high is higher than all of these, then this is a local pivot point. So that's a pivot high. Same thing for the pivot low. So when the purple point is below the candle, we consider that we have a pivot low, which means that the minimum of this particular candle is lower than all the minimums on the left and on the right of the neighbors. So how many neighbors on the left and on the right? And this is defined by the window parameter here. You can use 5 candles, for example, on the left and on the right, 6 candles, and so on. Candles are labeled. So we label the candles that are considered pivots in a new column named isPivot. So for each candle, we know if it's a pivot high, pivot low, or none of these two categories. Here I'm using window equals 7. So in other words, I'm taking 7 candles on the left and 7 candles on the right for each comparison to know which candles can be labeled as pivots. Then we need to visualize these points and just to make sure that the program is working properly. So for this, we are going to create coordinates of points that we're going to save in a new column in the data frame named point positions in this cell to plot this chart of the prices including the purple points, marking the pivot points or the pivot candles. Then we can define the function to detect the structure. So liquidity sweep plus breakout. And it takes the candle integer index, it takes the number of back candles and the window. The window is the same actually to detect the pivots. So it's going to pass this parameter along to the other function. But this number of back candles is actually the total window from the current candle backwards that we're going to consider to detect pivot points and to detect for the specific pattern. So it's usually 30 to 20 or 30, 40 candles, something like that. So here I've used 40 candles for back candles, window equal 5, and this is the candle index. So we're going to run this function for each of the candles in the data frame. So what it basically does is going to look just before that candle if we have a pivot low, and it's going to measure if before that pivot low we have a pivot high, and then it's going to test if the candle is closing above the pivot high. And also it's going to compare the pivot low that we've just found if it's lower than the last pivot low. So basically, it's actually, I know it sounds complicated, but it's basically looking for this kind of pattern. So we have a candle here closing above the last high. So that's the pivot high here. And since this candle closed above a recent pivot high that occurred within the slice of window of 40 candles that we have just defined, then we're going to check if between this high and the closing or the breakout, we have a pivot low. If we do, we just test if the lowest value here is the lowest among the other candles in the bigger window, in the back candles window. Because in this case, we know that it's lower than any minimum or any pivot low that has previously occurred. And that's what we're looking for. We're looking for a price where we have a high or a resistance level somehow, local resistance level. Then we have a liquidity sweep, so a very low dip of the price, lower than all the lows in the recent time window. And then followed by a breakout above this key level, which signals that the price is going to continue up. It has greater chances that the trend is going to be up, at least for the few coming hours. So within the function, you will find some details. For example, I'm also testing if the previous candle, for example, did not already break the level. We're just checking for the first candle that's going to break the level, because we don't want repetitive signals over the same level if they are happening in consecutive candles. Only the first candle, because we need to catch the signal as early as possible. Now, just before we continue, it's very important to make sure that we're not having a look ahead bias. Since to detect pivots, we need to check the candles on the right and on the left of the candle. In this case, we don't want to check in the future because we don't have access to the future. So all we have access to is actually the current candle. That's the most recent data that we can consider in our computation. This is why while we are computing the pivots, in this case, in this line, we're just going to stop at current candle minus window plus 1 in order to include the candle minus window position. Remember that the breakout is detected in this condition, so we're all in this condition of breakout. So if the current closing candle is above the last pivot high value, and also the previous candle was below the pivot high value, so it didn't really do the breakout, so we're catching the breakout as soon as it's happening, then we're going to compare if we have, or confirm if we have a sweep condition or liquidity sweep. In this case, we return 2, that's a bullish breakout, and we also return the index of the candle where it's happening to be able to plot it again later on when we visualize those signals. So we need to visualize the breakout happening. So that's the white triangle here, that's a bullish breakout, but also we need to visualize which is the key level that was broken. And then visually we can check the minimum and we can see that it's lower than the previous minimums. So I can zoom in to show you. So that's the white triangle here that's visible. That's the bullish breakout. And we can see that the price actually continued for 4 hours climbing after this breakout happened. And this is it basically. So then we have the bearish side, and then we're going to run this function, applying it to the whole data frame, so we can save these into a new column. I'm going to show you, it's going to take a bit of time. So this is why I'm using an indicator to show me the percentage of the progress of the work. Then we can filter the breakout signals by the confirmation coming from the EMA signal. We said previously in this video that we're going to filter the bullish breakouts only when we have a bullish trend, which is confirmed by the moving average curve, and the bearish breakouts when we have a bearish trend confirmed also by the moving average signal. And this is where it's happening. It's just this line that's going to compare these two signals, the breakout and the EMA signal, as going to confirm whether we keep the signal when they are both converging to the same conclusion or not. And now we can define a function to visualize these signals on the chart. So this is the plot breakouts with candles. I'm going to show you an example how it works. It's going to we're going to call the function, provide the data frame, the starting index and the ending index where we want to plot the candles. And this is how it looks like. So we have a pivot candle here. We have a breakout here in the bullish direction. This is why we have this triangle, this white triangle below the candle. We can actually increase its size at some point here. So that's triangle down. I'm going to double it, 20 and 24 up. I'm going to run it again. And as you can see, so we have this bullish triangle here. So we have the breakout happening. You can see the level that was broken by the current candle coming from which pivot point. So that's the pivot candle that generated the level. And we have the liquidity sweep because the minimum is lower than all the minimums occurring in the previous 30 candles window or 40 candles window. And what we can see is that just after this breakout, the price did continue for a few hours in the uptrend direction. Now we can try another one just to verify that it's working. Let's say I took the previous one, the first one, 881. So I'm plotting all the signals here. I'm printing these. 881. So we can plot 800 up to, let's say, 920. 900, and it looks like this. So that's a bearish one, as you can see. Let me zoom in, show you how it looks. So we have this bearish pivot point that was broken at this candle. So we have a breakout in the bearish direction, and the liquidity sweep that happened just after, because the high is higher than all the previous highs in the window in the most recent candles. So that's working well. And we can see that after this candle, the price did continue to go down for 2 hours. It's not very impressive because it's just 2 hours, but we had to wait until this candle closes below the level. Now, this is a third case where we did have a breakout. We're going below this level, but the issue here is that the liquidity sweep is considered this one. Because if this is the pivot low, we need a pivot high that's between the current candle and the pivot low, which is this one, that is higher than the highs, the previous highs. So the previous high is this one. So this one is considered by the algorithm, the liquidity sweep. This one is considered the breakout in down direction. And actually we can see that it's a downtrend. We can see that the downtrend of the candles, but in this case, the price reverted back up. And it wasn't really a correct signal. However, we could see that the form, the choppiness of the market is not really encouraging here. So numerically, it fits within the conditions that we have designed. But if you get an alert from your algorithm and you see this happening, it's true that you have a signal, but you don't have to take it actually. You can judge on your own first before confirming to take the trade. Let's try a fourth one. I promise it's the last. It's just that I want to make sure that things are working properly. So 3,395, let's say 300 and up to 3,450. Let's see how it looks. This is a very nice signal as well. So we have this high, this breakout happening here, and the liquidity sweep happening right here. And as you can see, after the breakout has happened, imagine we open the trade at the closing of this candle where the signal is happening. We still have 1, 2, 3, 4, 5, 6 hours, or 6 or 7 hours, give or take, to close a winning trade. And the range is actually huge. You could literally put your stop loss below the current candle's low here, and you would easily get a 2-to-1 take profit stop loss ratio. So I'm not going to backtest it manually for all the trades or for all the signals, but you can see that it's working well. Here we have 2 consecutive signals, 3,700. So, and you can see that you have, we have those 2 signals because in between these 2, we had one red candle that closed below the level. This is why they were signaled properly. But anyway, you would be taking the first one, and we can see that it's really a good one. So we have a good breakout followed by an uptrend, which is confirmed by moving average. And actually this indicator is really good. Now I've tried to plug this indicator into full backtesting strategy. The issue is always trade management. So I didn't code anything fancy. It's just an ATR related stop loss distance and the take profit stop loss ratio to conclude with the take profit. And I could run it easily and show you the results. So I'm trying to maximize the drawdown or minimize the drawdown actually, because drawdown is negative. And it's going to run over many different cases of ATR multipliers, so stop loss distances, different stop loss distances, and different take profit stop loss ratios. And this is why I'm running this using this grid search approach in order to get this heat map. And this is the drawdown. The less risky strategy is actually obtained for an ATR multiplier of 1 and a take profit stop loss ratio of 1, which are not the best numbers to maximize the returns. It's just to limit the risk. So we need to find a compromise between minimizing the risk and maximizing returns. I'm going to show you the heat map for minimizing the risk, and then we can do the same to maximize the returns and see what kind of potential we have in this case. So the results are the following. We're going to get 5% in returns in total. So that's not huge considering that we have 20 years of data. The win rate is actually 53%, which is not bad at all. Number of trades, 208. That's not huge. That's around 10 trades per year. And this is the issue of this kind of indicators. I mean, it's very selective. The win rate is usually high. We don't see it here because it's coupled within this strategy to the stop loss and the take profit distances. But whenever we test this manually, we could see that the price is always confirming the or confirmed by the breakout, or the breakout is actually legit. It's giving us good signals. However, the trade management later on is very important because sometimes you reach the maximum earnings within 4 to 5 candles, so 4 to 5 hours, and sometimes with just 2 candles, and then the price reverts back and so on. So you don't want to risk a lot, but also you want to maximize your gains in order to leverage the full potential of such an indicator. Now we can run the same optimization in order to maximize the returns. I'm going to show you this very quickly. So it's going to run, and the results for different ATR multiplier coefficient and take profit stop loss ratio as well are usually the best on the high end of these two values. So a take profit stop loss ratio of around 4 up to 5, and an ATR multiplier of also above 4 will give a zone of positive values. As you may have noticed here, we have 4%, 2, 15, 22, 30, 39, and 52% in returns. So this is if you want to maximize the returns. Minimizing drawdown area, if we are at the 1-1 here for the two ratios or the two parameters, we are limiting our risk to -1%, if I recap correctly, minimizing the drawdown, but also our returns are limited to 5 to 7 or 8%. And the reason that we're not seeing an explosive return percentage is that, first of all, we didn't use any margin, we didn't use any leverage, we're just trading with $10,000 on its own. I didn't include commissions as a first trial, to be honest, because the purpose of this video wasn't to present the strategy. It was mainly focused on the indicator. And honestly, I can confirm that it's really a good indicator and the automation part is amazing. Ideally, you would use it, including it in a bot, where the bot will send you alerts when this happens, when this situation or breakout happens, and you can open your, application or platform, and you can trade manually. So the trade management part should be done manually. I didn't develop any specific strategy or trade management that would be ideal for this kind of indicators or this kind of trading. Well, maybe you could develop it yourself, or you have something already that you're using that you can put it in a code. But for the moment, I'm including this quick backtest just to show the potential of the indicator in a very approximate way. Or also you can run the same indicator simultaneously on multiple assets. This way you can multiply the number of signals without sacrificing the precision of the indicator. So this was it for this video. I hope you guys liked it. I hope you found this information helpful. Until our next one, trade safe and see you next time.